Today, we're going to speak about the NASDAQ 100. And the reason we're going to speak about the NASDAQ 100, not because everybody loves to trade it, but because this could be your biggest opportunity to take advantage of the massive sell that's coming on the NASDAQ 100. Now, before we get started, if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the video, please smash the like button for the YouTube algorithm. And as always, let me know down in the comments below exactly what it is that you would like for me to cover in my next video. Now, today, you're going to learn a lot. Not only are you going to learn a lot, but everything that I'm going to say is going to make so much sense that you're going to be so confident, like you always are, to just go into this market and say, I'm excited, I want to get in, and I know where to get in as well. Now, the NASDAQ 100, as you know, is a composite that's made up of 100 top tech stock companies in the US. And the thing is, tech companies generates a revenue through consumer spendings. When consumer spendings are high, the stocks tend to rise. When it's low, tech stock companies tend to drop. Consumer spendings drop due to higher interest rates. Okay, now keep that in mind. Now, we're going to start with the NASDAQ 100, and we're going to look at some order flow, and we're going to look at some fundamental and so we're going to look at some technical order flow and fundamental data. Now, if you start on the monthly time frame, I think it's as clear as daylight that the NASDAQ 100 currently is trading in bearish territory. The market over here printed strong level of resistance. The market broke above that, printed the same formation, then came back to test support held for 2 months. Then the market then pulled back, and the market finally broke below support after it tested the neckline of their information. Now we can definitely expect that continuation to the downside. All of this support over here, okay, is now turned the resistance. So there is a possibility for the market to come and test that level before continuation to the downside. We also had this impulse correction, and that we expect that continuation. And if you take your Fibonacci from the high to the low, you can see how the market rejected the 61.8, which is known as the golden ratio. And if we measure our take profit level at the -27, you can see it's lining up perfectly with that previous level of resistance that is now acting as support in the market. And we're going to use that as our long-term target as well. And if we drop down on the weekly time frame, what do we see? Now, from a weekly time frame, the NASDAQ is currently holding on to live support, no pun intended, because the market is trading at support. However, if there's one thing that we do know is that we expect the NASDAQ 100 to continue lower, but the market is stuck within the monthly consolidation. The only problem is we have to be reactive and not predictive, and we have to learn to adapt to the ever-changing market environment. Now, I did a breakdown when the market was sitting at this level, explaining all of the reasons why we can see that meltdown start to the downside firstly, and that is exactly what the market had given us. Now, if there's one thing that you need to remember is that although the market is sitting at a level of support, that doesn't mean that support's going to hold. Why? Because fundamental analysis will always overpower technical analysis. Technicals say that you buy low, this is what we call a double bottom, like a lot of people would call it. For me, this is just an equal low. This is a level of support. That's it. You don't need any fancy names over here. So by definition, based off technical analysis, teaches us that we need to buy at this level. But if the fundamental data comes through, then this level is not gonna hold, and that is kind of what we expect. So we firstly don't expect the NASDAQ to completely correct itself. What we do want is at least we want at least a pullback to the 0.382 potentially before that continuation to the downside. Now, if you drop down on the daily time frame, what do we see? Now, if you look left over here, you can see this was the last level of support that the market had created. This level over here acted as support, that got broken. All of that support's now turned the resistance, and that's kind of where we can expect the market to pull back before that continuation. The market also printed an impulse, and after an impulse you expect a correction, and the best way to measure that correction is by taking your Fibonacci from the high to the low of the impulse, and you can see that we do have a 50% pullback to that level. So we can definitely expect the market to pull back to that level first before we can see that continuation to the upside. Now, if you're wondering why am I so confident that this is going to happen, well, it's quite simple, and we've spoken about this many times before. Firstly, we know the Federal Reserve is going to hike interest rates by 0.5 basis point. Now, we're going to get to the fundamental side of these things very quickly. Lastly, secondly, if you look at the the COT data, so the commitment of traders. This tells us what the biggest banks, hedge funds, and institutions are doing in the market. Now we can see here, based off last week's report, hedge funds are starting to close their buying positions in the NASDAQ, and we can obviously see that selling pressure that took place last week, and we can expect that continue into this week. They also had 474 selling positions on the NASDAQ there as well, and again we could see the price action taking place in there also. Now this is the part where you need to listen to me very carefully. The Federal Reserve is going to hike the interest rate by 0.5 basis point on the 4th of May, right? And you've probably seen the image I had on my, or the chart that I had on my Instagram story yesterday. If you don't understand how that works, I'll explain it to you right now. But one thing I want you to understand is the following. Before we go over the chart, you need to understand what I'm about to tell you in order for this to make sense, right? So this is what it looks like in layman's terms, right? When interest rates goes up, I'm just gonna call it the, I'm not gonna say the NASDAQ, the stock market goes down. That's it. Now I'm gonna prove this to you also. Now if you go look at the chart that I was referring to earlier, which is over here. Now this is a chart that tells us what the Federal Reserve interest rates are and what the S&P earnings are. Now what you see over here is the black line represents the S&P 500 sorry, and the blue line represents the interest rate. You can see here that every time the interest rates went down, the stock market went up. Now you can see here when the interest rates got dropped, the stock market went up. Now you can see here when the interest rates got dropped, the stock market went up. And you can see here when the interest rates went up over here, the stock market took a nosedive. You can see here when the interest rates got increased, the stock market went down. Every time the interest rates are increased, the stock market goes down. Interest rates are increased, the stock market goes down. Now we are going to see the same story that is going to play out here as well. And this is why I'm telling you. So, and I'm sure because I've spoken so much about this as well, but you probably know by now that rising interest rates isn't good for company profits, since they actively discourage consumers spending their money. But we can see, just looking at this chart I'm not sure if I closed it, but we can obviously see seems like I've closed it, but we can obviously see, just looking at the chart that we've just spoken about now, and like I said, the black line is the interest rates, the blue line, okay, you can see that the profit growth of the S&P 500 companies has fallen after pretty much every Federal Reserve hiking cycle since 1990. That suggests basically profit growth will suffer now that we headed into the next interest rate hiking cycle, which is even more of a concern than usual. You see, there are three ways that investors as well as retail traders make a return from stocks. Basically, it's when company valuations increase, higher dividends, and rising profits. And since valuations are already so high and dividends are low, investors need profits to keep rising. But if history is any guide, that's not going to happen, which could lead to investors bail in their stock prices, because if they look at historical data and see what had happened to the stock market, the first thing they're going to do is they're going to jump out of their positions, and that's basically they're going to bail from the stock market because they saw how the stock market prices had dropped. And if you think that's about to happen, the best way to position yourself, okay, is to make sure that you get in on the sell at the best price and hold it till it drops. Now that is it from my side. I hope you guys understood what I said here, but this drop is gonna come. I know I've said it in January, and the market was sitting there, and I've been saying it, but now I'm giving you another opportunity to get in as well. I'll say thank you so much for your time, thank you for the opportunity, and as always, cheers for years.